This video will help you understand what to do if you have excess investment losses. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, and I specialize in working with folks to and through retirement. Now, there's a lot of ways, as you can imagine, to take an L and take some losses in the investment space. Obviously, you could make a bad bet, purchase a security that you think is going to go to the moon, and then it actually goes into the crapper, and you need to sell out of that and you generate a loss. In addition, you might invest in a particular company and think it's also going to go to the moon, and then it actually goes completely bankrupt. And that would be considered a total loss in your investment portfolio, where you don't have a choice as to when you want to get out. The stock is worthless, so you've lost all that money. In addition, and this is a lot of times the case for retirees that I run into before they come to our office, and that's if they have to sell out of a particular security to meet cash flow needs. So let's say they've invested their portfolio in a particular way, and they're looking at next month's mortgage or next month's property tax bill, whatever, and they need to sell out of a particular security to generate enough cash to pay that bill. That's also a situation whereby involuntarily you're kind of selling and taking a loss. And the last one I could think of off the top of my head would be proactively selling to mitigate taxes. And that'd be through tax loss harvesting. We touched on that in a previous video, which I'll link above here, but it essentially boils down to proactively selling out of a particular security because you're going to generate gains elsewhere in your portfolio, either in that current year or you forecast doing so in future years. The good practice with tax loss harvesting is you only do so within the confines of a particular allocation of your portfolio. That way you're not, like chasing tax losses. More so you're just making a tactical pivot so that your fundamental allocation doesn't change, but you still take a loss. Now, regardless of which of those situations you might fall into, or another one I didn't think about, if you have excess losses, there's a couple of things you're permitted to do in the tax space. And so in today's video, we'll jump into what that looks like. So let's jump in. Now to clarify, the only tax losses I'm talking about in this situation are losses that you generate through passive investment activities, not inside of a qualified investment account. So to be a little more clear on that, the passive losses I'm talking about do not include things like 401k losses, IRAs, life insurance cash values, annuities, that kind of stuff. I guess you could throw in, health savings accounts, for example, if you have, investment losses in there. All of those are within the shroud of a qualified account, whereby you get tax benefits and tax deferral on capital gains inside those portfolios. So any losses that occur within those portfolios don't help you out from a tax perspective. So I'm only talking about the accounts that you would otherwise have. For example, if you're like a technology employee, you're going to have a TOD account that your company sets up for you, and that's where your stock is going to vest into. In addition, a lot of clients have set up things like Betterment account, Robinhood accounts, E-Trade accounts, that kind of stuff, whereby they can do their own trading, and that's usually considered like a non-qualified account. In addition, real estate transactions would count as passive investment activity. So for example, if I have a piece of rental real estate and I sell it, if I sell it for a gain, that'd be considered a capital gain or loss. Now, if it's my primary residence, there's some exclusions to how much gain I have to recognize, but to keep it simple, that's considered passive gains, and you could even make it a passive loss. So there's two main things that happen when you take excess losses, and probably a combination of the two. And those two are either taking an ordinary income tax deduction on your return, or carrying forward any excess losses to future tax years indefinitely. And most of the time it's a combination of the two, so let's talk about those. So the first one, taking a tax deduction. The way that this works is if you have more than essentially $3,000 in excess capital losses for the year, the IRS will permit you to take a $3,000 tax deduction on your return for that current year. Now, taking an ordinary income tax deduction is generally more tax favorable for taxpayers than taking long-term capital gains losses and carrying them forward. And that's because ordinary income tax rates are higher than long-term capital gains rates for pretty much every situation I can think of. So said another way, if you could have your druthers, you'd want to take all of your losses as ordinary income losses and all your gains as long-term capital gains, because long-term capital gains are generally taxed at a much lower rate. And for those rates, I'll post them here and here. Essentially, over here, we're going to see long-term capital gains rates range from 0 to 20%. The tax brackets climb quite a bit, and the maximum long-term capital gains rates on this chart is 20%. There are some investment proceeds that are taxed at a higher rate than 20%, but to keep it simple, 20% is the maximum long-term capital gain rate. But over here on the ordinary income tax bracket front, we can see that ordinary income can be taxed all the way to 37%. And that's not including state income taxes, nor net investment income taxes, nor Medicare taxes, like from a payroll standpoint, because those are always taxed on your income. Because as opposed to FICA taxes, which have a certain limit if you make enough money. If you make $1 million, all of that is subject to Medicare taxes. So to keep it simple, generally, you want to take ordinary income losses and you want to pay capital gains tax. In a future video, we'll touch on the nuance between short-term gains and losses versus long-term gains and losses, and what can offset which and how so. But you don't really need to know that for now, because generally come January, February timeframe, whatever investment custodian you use that handles your non-qualified investment assets will produce a 1099 that will show you exactly which tax qualification, which particular gain or loss is subject to. And then you just either upload that to your tax software or you hand it to your tax professional and they figure it out. Now, in the unique circumstance where you show a negative taxable income, while your return will show $3,000 or $1,500 of your net capital losses being used on your return to take a deduction, it actually doesn't affect your net capital losses. You'll just carry forward those net capital losses indefinitely. And I'll link to the article that kind of explains what's going on here. Though it might show on your return as a deduction, you're already at a negative taxable income, so you don't actually take $3,000 off of your net losses. You can carry forward all your losses plus that $3,000 you otherwise would have deducted. And while that might seem like kind of like a wonky situation where you have a negative taxable income, a couple years ago, the majority of taxpayers did not actually pay federal income taxes. And then I think nowadays the number's closer to like 40%, and it kind of floats between like 40 and 60% as to how much of the US population doesn't pay federal income taxes. So that's the first thing that happens when you take excess losses, is you're permitted to take a ordinary income tax deduction. The second thing that happens, though, if you have excess losses beyond that, is you're allowed to carry forward those losses indefinitely. Meaning in future years, whenever you generate gains, until you gobble up all of your net losses you took previously and been carrying forward indefinitely, until you offset all those with gains, you're allowed to carry forward that loss. This is reflected on Schedule D of your tax return, and the reason you're going to want to know that is because if you work with a tax professional, or even if you work with a software, while we might assume that Schedule D is verified and that you're carrying forward those losses, you might want to manually verify that that's all getting plugged in correctly, because by no means is the IRS going to proactively remind you how many losses you have. You're probably going to need to manually track that on your own, because if you forget losses that you took in 2018 and now it's 2023 and you're looking to offset some gains, unless you have a paper trail of that, it might be kind of hard to justify to the IRS why you didn't pay taxes on those capital gains. And taking excess losses and carrying them forward can be very helpful for future tax years. For example, at the end of 2022, there was quite a bit of market volatility and we were able to harvest a significant amount of losses for clients. And again, we didn't change the fundamental allocation of their portfolio, and those are all appropriately risk allocated to the client situation. We were able to make some changes to the investment selection, intra-portfolio, and capture some losses. And those losses, clients are now able to carry forward for 2023's taxes, 24, 25, etc. Now, 2023 has actually done pretty good from an investment standpoint, at least with our clients. And so I imagine those losses are going to get gobbled up. But even if they don't get fully gobbled up, great. We've got some more losses we can carry forward to 2024. And again, at a minimum, if you suffer losses for a long period of time, or at least you never fully offset those gains in the future, you're permitted to take that number one option we talked about, which is taking that ordinary income tax deduction every single year until all your losses are used. And taking losses and carrying them forward is super helpful, especially in situations where your investment portfolio stays relatively flat. And that's because if you keep it simple, let's say you took 15 grand of losses in 2022, and you're planning to offset future gains with them, but your portfolio stays flat over the next 5 years. Well, over those next 5 years, since you have no more recognized gains to offset those losses, then you're allowed to use that $3,000 ordinary income tax deduction every single year until those carry forward losses are completely absorbed. So from a tax perspective, that might be like the best situation, because again, ordinary income taxes are usually much higher than capital gains taxes. Okay, so as we wrap up, what are some calls to action? Well, I can think of like two, which is number one, make sure that your Schedule D reflects the losses you're trying to carry forward indefinitely. When you're looking at preparing your tax return, February, March timeframe, and whether you do your own tax prep or you delegate to a tax professional, make sure you've verified that the Schedule D losses are being carried forward, and ensure that you're taking that $3,000 tax deduction. Again, unless you're married filing separately, then it's $1,500. But to keep it simple, make sure you're taking that $3,000 ordinary income offset, and then also make sure you're future losses are being carried forward indefinitely. So hopefully that was helpful. If you have any further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your week. We'll talk to you later. Bye.